Happy Wednesday, everybody. So does Wednesday feel a little bit different, knowing that you won't have to be in class on Friday afternoon? Yeah. Hey, don't cheer. Don't cheer. You get to miss out on a valuable educational experience. Oh, no. So I have an update. So I went on, I was posting to YouTube my earlier lecture today, and I noticed that after the fact, somebody started liking my Accounting 417 videos. Don't jump too, Carter. It's not going to work. Yeah, you already burned that bridge, right? Already burned that bridge. Yeah. So we do have a little bit of good news today. As much as I joke around about it, we get a little bit of a break after this. I think we can all use a break. We're not meeting on Friday. It's going to be our last lecture for about a week and a half. And the bad news is, this is a really important one. Okay, this is a pretty critical one. So this is basically audit reports, and if you've looked at the practice exam that's coming up, the audit report section on the practice exam, there is a problem worth 12 points, which that doesn't sound like a lot, but it's only 60 points, so it's 20% of the exam. 12 points, that's basically to spot the errors. I do this on every single audit exam, and it will be on this one as well. So I'm going to give you an audit report, and you're going to have to figure out what's wrong with it. There are always 5 things wrong with it, and you're going to have to do your best to identify them. Some of them are very easy, some of them are not so easy. So that's something you should be prepared for. Does this mean that you have to memorize the audit reports? Probably not word for word, but you do need to know it really, really well. And so we're going to talk a little bit about what the responsibilities are for that today. There's also some other stuff that will be included in the multiple choice questions. I think there will be 1 or 2 questions on multiple choice for this. Probably around 2. I don't think it'll be 3, but I could be wrong. So yeah, let's go ahead and get started. By the way, I will tell you right now, this is not something I do because I'm just a big fan of memorization of items, but this is a big focus. Reporting is a big focus on professional exams. So if you're planning on sitting for the CPA exam, you will have to know this one. Not only this, you'll have to know the ASB report, which we're only going to focus on the PCAOB report. The ASB report is a entity unto its own. It's basically, it used to be so nice and short, 1 page, and now the ASB said, you know what, we don't think that our CPA candidates have it hard enough, so we're just going to make it multiple pages long. Fortunately, you do not have to worry about that report for this course. I'm just going to focus on the PCAOB reports. If you're planning on sitting for the CPA exam in the future, that's when you can start worrying about it, because there's a lot of content there. So what are the elements of the standard unqualified audit report? So again, just as a reminder, when I say unqualified, is that a good thing or a bad thing? That's a good thing. It means there's no qualifications being made by the auditor. Okay. What is the ASB report version of that called? Unmodified. Okay. So they're the same type report. They're not the same format, but they mean the same thing, is that everything is fine. What does it look like? What are the standard elements? So I'm going to give you 8 elements. Now, the question always comes up, if we memorize these elements, will this be sufficient? I say, if you memorize these elements, you can get 6 points out of 12 pretty easily on the exam, that 12 points that I'm talking about. So this is not sufficient onto its own. This is just framing for what we're going to look at in more detail. So the first part is pretty easy, report title. And the report title is pretty boilerplate. It has the same exact vernacular every single time we're going to see it, report of the registered independent auditor. After that, we're going to be talking about the addressee. Now, the addressee is not particularly complex in PCAOB reports because it's always going to be the shareholder clients. So the shareholders and board of directors, I believe it's just shareholders and board of directors, but I will see here in just a second, whoever the client is, because they're the ones who request the audit. After that, we get the opinion, all right? The opinion that's being rendered in the report, whether it's unqualified, whether it's qualified, whether it's adverse or a disclaimer opinion. We obviously know this is unqualified because this is the type of report we're talking about here. But the opinion is always rendered in this section. That's right at the beginning of the report because that's the most valuable piece of information. What did the auditor say regarding the financial statements? All right. So now we get into the nitty gritty. This is the details. You want to take some notes on these. So next is going to be the basis for opinion section. This contains 2 paragraphs, and there's multiple elements to these paragraphs. So the first element is the very first sentence of the first paragraph. That is management's responsibility. And it basically says management's responsible for the preparation and presentation of the financial statements. That's all there is to it. 1 sentence about management's responsibility. The rest of that first paragraph details the auditor's responsibility. So first part of the paragraph, first sentence of the paragraph is management's responsibility. Everything else in the paragraph is the auditor's responsibility. The next paragraph, the second paragraph, is entirely related to something called scope. Okay. So we've talked about scope limitation. That basically dictates that the auditor cannot perform their work. What work? Well, that's what's detailed in this particular paragraph, the work performed by the auditor over the course of the audit. So just as a reminder, basis of opinion, 3 basic sections, 2 paragraphs. First paragraph contains management's responsibility and auditor's responsibility. The second paragraph contains the scope of the work performed by the auditor, which will become very, very important when we start talking about the different types of opinions. Next, we have critical audit matters, which I'm going to hold off on talking about in more detail here in just a second, because I've got an entire slide dedicated to critical audit matters. All right. Then we have the name and signature of the auditor. So basically, should have the name typed out, and then the auditor should have a signature there. If it's a big firm, it's not going to be signed KPMG. It'll be whoever the partner was that's in charge of the engagement. I will tell you that I've gotten a little bit better about putting both name and signature on there. It's been a little bit confusing because I haven't tried to use a signature tool on there. That being said, unless it's otherwise specified, if you see the name, you should always assume that the signature's there. I will leave both, or I will put both on there. I will put none of them on there if I'm leaving it out. Or sorry, I will put it on there, or I won't put it on there. You can assume that if one is on there, then both of them are there. So if you just see the name listed, you can say, all right, Dr. Barnes says this applies to both name and signature, and that's mostly because I'm being lazy and don't want to try to do a signature tool on the report. That's just kind of a quick note on this. Next, we have something that's really interesting called the auditor tenure. Okay, the auditor tenure, and this is just how long the auditor has been auditing a particular client. This became really, really critical a few years ago when they wanted to know what the independence threshold is. So with respect to independence, if you've been auditing a client for a long time, you may have independence impairment because you may be way too familiar with the client, have too close a relationship. That being said, there's no particular criteria with respect to auditor rotation for PCOB clients. There is a criteria with respect to partner rotation, which is every 5 years. So this statement is kind of meaningless simply because they don't require auditors to rotate off non-clients. Then we have the location and audit report date. So where the audit took place and when the audit was concluded. We talked a little bit about this on Monday. The audit report date in recent years has become the same date as the issuance of the financial statements, but it doesn't have to be. It can just be whenever the auditor substantially concludes their field work if they choose to use that. All right, so 8 elements. Again, this is the basics. This is the basic stuff, okay? This is the starting point. You do need to know this, but you also need to know much more. So we're going to talk a little bit about what that entails. What I'd like to do real quick is I'd like to just go ahead and show you example report. So you will notice online that some of the elements in this course, I believe it's in the content folder of it's in the content tab. It's in that tab. It's something called PCOB audit report examples. The very first page is the standard unqualified report for the public company PCOB standards. So a couple of notes here. So let's go through the elements. This is our report title up here, Report of Independent Registered Public Accounting Firm. Again, that language will always be there if it's going to be there. If it's not there, then it's missing something. Then we have our addressee, which I said is the shareholders and board of directors of EWC, which is our client that we've been doing our audit for. Then we have our opinion. Now, this is an unqualified opinion, so we should have the statements. Financial statements present fairly in all material respects the financial position of the company as of year end. All right. Now, a quick note on the opinion paragraph. This always gets confusing. Keep in mind that oftentimes, especially with PCOB reports, these are based on comparative financial statements. So what is comparative financial statements? These are things that you are already familiar with. If you ever looked at a 10K, it presents information for the current year and then previously preceding years. So usually 1 or 2 years previously preceding. So we can compare information from one period to the next. This is reflected in the opinion. Okay, so the consolidated balance sheets for December 25th and 2024, and then the statements of operations, stockholders' equity, and cash flows for each of the 3 years and prior year ended December 31st, 2025. I will make you a promise on this. I will never manipulate this particular piece of the question or piece of the audit report in any questions. This is something that always gets confusing. If somebody says, well, they only audited the balance sheet for 2 years, but they audited the other financial statements for 3 years, and that's obviously an error. No, I will never make that an error. That's not an error because we do comparative analysis for 2 years for a balance sheet and 3 years for income statements and other financial statements. So if you ever trying to find errors in an audit report, this is not going to be an error. I will never manipulate that. I'm not saying I won't manipulate the opinion paragraph in some way, but this first part where it talks about where the comparative financial statements periods are, that will not be a manipulation on my part. All right. Down here, you will notice highlighted in green, at least highlighted a different color here, is another paragraph. This paragraph I wanted to highlight, this is an explanatory paragraph that actually refers back to the audit of internal controls over financial reporting. Remember, we talked about this in chapter 7 and said that we had to issue a separate report for audit over internal controls over financial reporting. We are not going to look at that report either in this course, but in most PCAOB audits, there's a requirement that we perform this audit as well. This paragraph is simply a reminder that we did that as part of our audit testing. The reason I highlighted this in green is that I will likely not present this particular paragraph ever again in this course. All right. I will deliberately exclude it just because it's not as relevant as everything else in here. But in most situations, get out of the way. Oops. Oh, okay. Oh, that's just, okay. There we go. That particular paragraph will not be present on other examples. Now, should it be there? Yes. Okay. It should probably be there. But again, it's just confusing as to why it's there. Plus, it also messes with other things that go in this space right here. So if you see this the one time, you can appreciate it and evaluate it right now, and then you can ignore it for the rest of the semester, okay? It's not going to be there unless I specifically say that I put it there for a reason. All right, basis for opinion section. These statements of the financial statements of responsibility of company's management. That's all there is to it. I actually added to it. I said the preparation of presentation, but it's not. Financial statements of responsibility of company's management. That's the only statement we make on management responsibility. Everything else is the auditor responsibility, okay? Responsibility to express an opinion on the company's financial statements. We've got a public accounting firm registered with PCAOB required to be independent and follow laws associated with applicable rules and guidelines. All right. Then we have this paragraph right here. What did I call this paragraph? Also, it means mouthwash. Yeah. This actually, the scope still exists as mouthwash. It's been a long time. And it shows you how much I use mouthwash. Yeah. Anyway, I do brush my teeth. Don't look at me that way. All right, so this is a scope paragraph that details the roles and responsibilities of the auditor over the course of the audit, everything they performed. Then we have critical audit matters, okay, which we're going to go into, which critical audit matters is a big section right here that details this. Then we have Willis and Adams. There's the name, there's the signature. I actually included that in here just for you guys, and the other audit classes that I did before this one. So not all of them, unfortunately. Then we have the statement of tenure. They've been the auditor since 1975, so over 50 years. And then Boise, Idaho, February 15th, 2026. That's so auditor tenure, location, audit report date. So we're going to come back to that, but let's go ahead and move on. All right. So what are critical audit matters? Critical audit matters, these are called CAMs frequently, CAMs, are matters arising from the audit that are required or communicated or required to be communicated to the audit committee. They relate to items that are material to the financial statements and involve complex or subject of auditor judgments. Now, a couple of things to note here. First of all, I didn't like empty space, so I just did a whole bunch of searches for the word cam, and this is what it came up with, webcam. Apparently, there's a country western singer named Cam. Who knew? Probably everybody else in this room did. Cam Newton and then Cam Shafts. Okay, so there we go. Those are not the cams we're talking about. We're talking about critical audit matters. There are 3 requirements for a critical audit matter. I know it says 2. But this third one always gets missed, okay? So the very first one is that these are matters that have been communicated or are required to be communicated to the audit committee. That's probably the most important requirement. I don't know why they didn't list that as a number, but I guess they said, well, this is just really, really critical, so we're not going to list this separate. So this is requirement number 1. The second one, which is listed as requirement number 1, they relate to items that are material to the financial statements, and they involve complex or subjective auditor judgment. That's the third one. So even though the numbering system says there's only 2, you should think 3 and know what all 3 of those are. Okay, so that's basically the unqualified report in a nutshell. Now, there's times we can use an unqualified report, but we have to make changes to the wording. And to make changes to the wording can actually result in 2 different types of adjustments. First of these is modified wording, where you have to modify the existing wording within the financial statement or report. Secondly is an explanatory paragraph, which we've already taken a look at an example, but there's several more examples that we can talk about. Let's talk about the first example, modified wording. Modified wording occurs in one circumstance with respect to the PCAOB report and the ASB report to that extent. This is opinions based in part on the report of another auditor. Now, I want you to make sure you take a note on this because this can be a little bit misleading. So add the additional language whose work the primary auditor is not willing to take responsibility for, whose work the primary auditor is not willing to take responsibility for. Now, what does that mean? Whose work the primary auditor is not willing to take responsibility for? Let's assume that I'm on a big audit, okay? I'm Ernst & Young. I actually am Ernst & Young, okay? Ernst & Young. And I'm doing an audit, and I've got I don't know why you found that so funny, but that's okay. That's okay. Anyway, now I lost my train of thought. Yeah. I'm the auditor, and I'm using a secondary auditor to perform part of the audit. So they do part of the work on a subsidiary of a client, and I review their work, and I say their work is good. So their work is so good, in fact, I am willing to take responsibility for their work. So if there's any liability or litigation, I'm willing to bear that burden. If that's the case, I have to make 0 modifications to my report, right? I am willing to take responsibility. There's no modifications. But what if I look at their report and I say, it's good, but I'm not willing to take responsibility if there's a problem? If that's the case, we do have to make the following modifications. We have to add the following wording to the opinion and basis for opinion sections. And the wording is based on our work and the work of other auditors. Okay, based on our work and the work of other auditors. We have to specify that the work that was performed was not just ours, it was also on other auditors, so those other auditors can be held accountable for the work they performed. Also, for the PCAOB report, there's a requirement of an additional explanatory paragraph to explain what's going on with the reason why we're eschewing liability, so to speak. Why we're not going to take accountability for the work of those auditors, why we're not being held responsible. That's the PCAOB only. There's an additional explanatory paragraph. So again, modified wording, opinion based on a report on the auditor. If we're not willing to take responsibility for that other auditor's work, we have to modify the opinion and basis for opinion sections to include the wording based on our work and the work of other auditors. And then we also have to add an explanatory paragraph saying, yeah, we're not going to take responsibility for their work. In case you need to find somebody who did this work, go to KPMG down the road. They're liable for everything. Okay, I get to make jokes about KPMG. I'm an alumni. All right. So what about explanatory paragraphs? These are going to be fairly common. We'll see those consistently throughout reports. So the first example of an explanatory paragraph is that one that we have already looked at, the audit of internal controls over financial reporting for public companies. If we have performed an audit of ICOFR, we not only have to prepare a separate report, but we also have to allude to that audit in our financial statement audit report. Now, again, I said I was going to deliberately exclude that. I will actually leave language in the exam saying I deliberately excluded this paragraph. You will see it in the practice exam as well. So that's one example of an explanatory paragraph. Another one we're already familiar with is this thing called going concern. Remember, we talked about that on Monday. So what does going concern mean? Well, if we have substantial doubt about the entity's ability to continue as a going concern, we have to talk about that in our audit report. We have to add an explanatory paragraph. Now, why is it an explanatory paragraph? Does everybody remember my discussion on Monday when I said, if we include this in the audit reports, this does not necessarily change the opinion being rendered. And the reason behind this is pretty straightforward. Is it possible that you could have a client with immaculate financial reports that you think is going to go out of business? What does the auditor care about? The auditor cares about whether the financial statements are correct. Okay. The fact that they're not going to be in business a year from now, that's troubling, but that's not part of our reporting responsibility. So we don't change our opinion based on the fact that they're going to be going. Because remember, our opinion is saying the financial statements present fairly. It means the financial position is garbage, but their financial statements are great. They actually reflect that it's garbage. All right. So that's kind of the goal. Now, again, this is different from what I talked about on the second part on Monday, when I talked about this. I said, what happens if our client fails to disclose this in the financial statements? Is that a problem? Yes, that's where we would change our opinion to a qualified opinion or an adverse opinion, because that is a required disclosure under GAAP, and they violated GAAP. It's a departure from GAAP, which we're going to talk about a little bit more. Next, we need to talk about lack of consistency, and you should probably write some term next to this saying comparability is the key, okay? Comparability. So how well can we compare financial statements from one period to the next? So if we look at previous year's financial statements and they're not comparable to the current period, this is where we have to add an explanatory paragraph. This usually follows the lines of what you learned back in 303. What I mean by that is, if there was a change in accounting principle, a change in reporting estimate entity, or a change in a misstatement through previously issued financial statements, these will affect comparability from this period to the next. Now, I do want to throw out a caveat here because this is really, really problematic. Back when you learned about it in 303, what was a change in accounting estimate? How did you treat that? Was that a prospective adjustment or a retroactive adjustment? Dr. Barnes, that was like an entire semester ago, or maybe even multiple semesters ago. How dare you ask us our knowledge about financial accounting? Isn't it terrible that I'm asking you about stuff that you previously learned and it's been so long? Yeah, it's unfortunate. So it is a prospective adjustment for change in accounting estimate. Now, why is this important? Because most of the rules follow whether it was a retroactive adjustment or a prospective adjustment. Change in accounting principle, change in reporting entity, these were retroactive adjustments for financial reporting purposes. If it's a prospective adjustment, you'd say, well, we don't have to do anything because it doesn't affect comparability. And I say, wait a minute, it might affect comparability. All right. If you change your depreciation period from 7 years to 5 years, could that drastically affect your depreciation expense from one period to the next? Yes. And so the question of whether or not we need to report change in accounting estimate as a comparability issue, the answer is, what's always our answer? It depends, okay? It depends on how big that change is. If it's a small, minor change, that's not a very material change, then we probably can ignore it. If it's a substantial change that might affect the judgment of users, then we would need to report that. Now, this, again, when I say materiality, I'm not talking about perspective of misstatements. These are not misstatements. These are just changes in comparability from one period to the next. And then any justified change in accounting classification. And this usually comes up when there's changes in accounting rules for a particular industry. Then the final paragraph, or final reason that we might use an explanatory paragraph is additional emphasis. So basically anything else that we might need additional emphasis for. A common example of additional emphasis would be if we have the client has substantial related party transactions, we might make a note of that in the report saying, hey, you should know, client has substantial related party transactions. They're not illegal, but they're a little bit shady, all right? We wouldn't actually use that words. We just say, please bear in mind that they have related party transactions that might affect your perception of the financial statements. Okay, that's a lot to absorb. Everybody got on board? Everybody got that down 100%? Ready to take the exam? Yeah, okay, you're gonna be rewatching this video a lot. But unfortunately, we're only through one type of report and we've got 5 reports to talk about, okay? So I'm gonna tell you right now, this should be your basis, okay? The standard unqualified report, you should know this really, really well. Because if you know this really, really well, then you can actually make minor modifications to talk about the other opinions. So let's talk about the other opinions real quick. So we know about our unqualified or unmodified reports, okay? We can actually have unqualified reports with explanatory emphasis of matter or other matter paragraphs. By the way, if you see those wording, you're just like, what's the difference? You talk about explanatory, but what's this emphasis of matter and other matter paragraph? Explanatory paragraph is what the term the PCAOB uses. Emphasis of matter and other matter, that's the term the ASB uses. Because the ASB is like, I don't want to use the same words you do. Yeah, that's kind of how they are. That's kind of how they are. So anything that might require additional paragraphs, these are kind of a list of things that we can list out over there. What about other types of opinions? Well, we talked about situations that are material but not pervasive, misstatements that are material but not pervasive. That results in a qualified opinion. What were the 2 words that were important for a qualified opinion? Does anybody remember? Except for, okay, we're going to see that in our examples, okay? Qualified opinions can arise in 2 situations. If there's a qualified departure from GAAP or a qualified scope limitation, okay? Qualified for, or I should say material departure from GAAP, material scope limitation. Then we have something that's pervasive with material. And remember that word pervasive, we talked about that. That's really, really big. That term means really, really big, more than material. It affects the financial statements in a meaningful way. So if we're talking about a scope limitation, a pervasive scope limitation, that is a disclaimer of opinion. Basically, we're not issuing an opinion because we don't know what we're doing. Or we have a pervasive departure from GAAP, a big, big departure from GAAP. The material affects the financial statements in a meaningful way. That's an adverse opinion. Now, you may notice there's a little bit of a star here and it talks about this. This is not going to be relevant to our reporting. There is another way that a disclaimer opinion can arise if the auditor is not independent from their client. This will never happen under PCAOB rules because PCAOB guidelines require the auditor to be independent from their client. It might happen under ASB reporting, but that's not going to be as relevant to us, all right? Okay, buckle in, here we go. Let's go ahead and talk about the changes to the report. It sounds really, really daunting. It's actually not. Let's talk about a qualified departure from gap. This is the easiest change. So qualified departure from gap, the first thing we note that needs to change is the opinion, because we are changing the opinion. So remember, our original language was the financial statements present fairly in all material respects the financial position of the company. We have to add two very important words, which Ethan pointed out earlier, except for. The financial statements present fairly, except for the effects of not capitalizing certain lease obligations as discussed in the following paragraph. The financial statements present fairly in all material respects the financial position of the company. So basically the same language, but we add this intermittent statement that says, except for this one item, everything's fine. That's a characteristic of a qualified opinion. Now, you will notice here, it says not capitalizing certain lease obligations. Does that sound like a financial transaction, or does that sound like a reporting issue? An auditing issue. Sounds like a financial accounting issue, which is why it's a departure from GAAP, departure from generally accepted accounting principles. Now, an additional thing we have to note here is that there has to be an explanation for why we're going to give a qualified opinion. Now, this explanation is going to follow the same areas as explanatory paragraphs. We can still include explanatory paragraphs in this area, but it will precede those. It will always follow immediately following the opinion paragraph. Also, this explanation does not need to be one paragraph. It could be 2 paragraphs. It could be 4 paragraphs. It could be 15 if the auditor so deems. That's a little bit of overkill, but it can be any length the auditor deems appropriate to explain the nature of the issue. So that's pretty much it. Those 2 changes, everything else remains the same. So we're starting off easy. Everybody comfortable with that? All right, let's move on to qualified due to scope limitation. Qualified due to scope limitation. So qualified due to scope limitation has the exact same changes with the addition of one minor one that's really, really important, okay? So remember, scope limitation implies that we tried to do our job in a certain area. We could not do it. Therefore, we can't issue an opinion in that area. If it's a small scope limitation, if it's a material but not pervasive, we can use a qualified opinion. So the language is very similar, except that for the adjustments that, if any, that might have been determined to be necessary had we been able to examine evidence regarding the foreign affiliated subsidiary incentives and earnings as described below. So here's something we tried to look at. Here's what we were going to do. Here's the account balances. We were not able to ascertain whether those account balances are fairly stated. Therefore, we cannot issue an opinion in this area, but everything else is fine, okay? Except for this one thing that we weren't able to audit, everything else is fine. Now, there's one quick note. So these changes are exactly the same, except they reflect a scope limitation rather than a departure from GAAP. So that's important to note. But there's an additional change as well. By definition, what is a scope limitation? A scope limitation is saying the auditor could not do their job. With respect to a qualified opinion, they were not able to do their job in one specific area, or at least a minor area of the audit. Does that affect the scope of the work that you performed as an auditor? Well, scope limitation would imply that it does affect the scope of work that you performed as an auditor. Therefore, we do need to make a change to the scope paragraph. And it's a really minor one, but a really important one. We add the preceding statement, except as discussed above, and then we do the rest of the paragraph exactly the same as before. Now, it always comes up, would you actually test us on this one minor little issue? You bet you I would. If I put it in the report, then you better believe that I'm going to include it, okay? The bad news is that you're aware of that, and you're probably saying, well, okay, now I'm aware of that. Dr. Barnes can't trick us. Well, we still have 2 more reports to go. All right, so let's talk about the adverse opinion now. Let's talk about the adverse opinion. Adverse opinion is slightly more complex. So by definition, what is an adverse opinion? Adverse opinion is saying the financial statements are materially misstated. So we have to specify what is the reason for the adverse opinion, and then we need to say the financial statements are not free from material misstatements. The financial statements do not present fairly in all material respects, the exact opposite of what we said for an unqualified opinion. So because of the effects of matters discussed in the following paragraphs, the financial statements do not present fairly the financial statement position of the company in December 31st, 2025, 2024. By the way, I do not know why they moved the statement of GAAP up to here in the intermittent statement rather than a follow-up statement that they used in other paragraphs. It's just really, really weird, but that's, I probably won't test you on that. I won't say probably. I won't test you on that, knowing where the sequence of statements are. I will test you on your knowledge of being able to identify whether it's an adverse opinion. So the ordering of the language will not be something I test you on, but that's a really, really minor detail that I've never understood why they did that. So yeah, financial statements do not present fairly in all material respects the financial position of the company. Then we have to explain the reason. And you'll notice here the explanation is 2 paragraphs instead of 1 because there's no prescribed length to however much time the auditor thinks they need to explain the area. All right, that area. Then we notice the basis for opinion section stays the same, so we don't have any problems here. And then we get down to critical audit matters. Well, here's a question. This big issue that results in adverse opinion, do you think that's probably a pretty critical issue? Yeah, it's probably a critical issue. So does it make sense to talk about critical issues again? Probably not. So you'll notice this entire section is completely crossed out. What does that mean? It means that when we have an adverse opinion, we eliminate critical audit matters. We've already talked about the most critical audit matter that we established, and that was the reason for the adverse opinion. So the critical audit matters go away in an adverse opinion. So just to summarize, we change the opinion because we know that the opinion is now adverse and not unqualified. We add an explanation for our opinion, the further basis for opinion, and then we eliminate critical audit matters. So not too bad, not too bad. A few changes, okay? I've saved the best for last. I've saved the best for last. All right, let's talk about the disclaimer of opinion. So the one thing I want to tell you about the disclaimer of opinion, keep in mind when you're disclaiming an opinion that you as an auditor tried to do your job and weren't able to adequately, I don't know why I'm struggling with that word, adequately complete it. So you tried to audit, but you were unable to complete the audit. To that end, anything in the audit report that refers to what the auditor did needs to be changed to something in reference of what we tried to do. So this starts, it gets pretty ugly, okay? So there's 2 big types of changes, 2 big categories. You're going to see all the changes here in just a second. 2 big categories of changes. First of all, anything that refers to an opinion in a title is now a disclaimer of opinion because you didn't issue an opinion, you disclaimed issuing an opinion. Secondly, anytime you refer to something you did, it either is changed or gets removed completely. All right. I'd roll up my sleeves, but they're already rolled up. Okay. Okay, here we go. Disclaimer opinion on the financial statement. So we changed the first paragraph's title. Remember what it says we have audited the consolidated balance sheets of Earthwork over the years. Did we actually audit? No, we tried to. We were engaged to audit, but we couldn't do that. So we changed it to we were engaged to audit. All right. So 2 big changes that are not in the other types of reports automatically. Okay. All right. So then we move on and then we explain what is the reason that we could not do the audit. And so this is basically the change to the opinion section that's been consistent with the other types. An explanation of that. And it says we were not able to obtain sufficient appropriate audit evidence to provide a basis for our audit opinion on the financial statements, and we do not express an opinion on the financial statements. By the way, this is a little bit of foreshadowing for what we're going to be talking about week after spring break. But keep in mind, when we say the word, we do not issue an opinion, a disclaimer of opinion, a disclaimer just means anytime we as auditors did not issue an opinion. It's not something nefarious. It's basically, there may be reasons behind it. Sometimes it could be the engagement did not call for an opinion. So that may come up in week 9 when we start talking about attestation and assurance. But I just want you to make a note of that right now. The disclaimer opinion in this context is very, very bad. It means that we tried to do our job. We did not do it. Everything was a mess. All right. I had no idea what was going on. So we have our explanation of the reason why we couldn't do it. So we could not look at the inventory. The inventory was a critical account, and therefore we can't issue an opinion audit. All right. Next section. Remember, we have our basis for opinion. No, it's our basis for disclaimer of opinion. Okay. The financial statements are responsibility of the company's management. Our responsibility is to express an opinion on the company's financial statements based on our audits. So do we have a problem with that second sentence? Well, it's been crossed out. Why has it been crossed out?
Because we couldn't express it.
We did not express an opinion. We did not express an opinion. Therefore, we cannot make that statement. Okay. If we had that responsibility, then we should have expressed an opinion, but we didn't. Okay. So we're going to eliminate that statement. Next, you probably can see the preview of it. What was that paragraph after this paragraph called? Okay, the second part of the basis for opinion section. I've said it multiple times now. Scope paragraph. Okay, scope paragraph. Scope refers to the work performed by the auditor. What work did the auditor complete? They did not complete their work. They did not complete the audit. Guess what that means? Scope goes away. Scope paragraph goes away. It just disappears entirely. Why? Because we didn't complete the audit. We did not do our job, so we can't refer to the work that we performed. Also, remember what happened with critical audit matters in the adverse opinion report? What happened to the critical audit matters? They went away. So they also go away here. Okay. They also go away here. Whenever it's an extreme opinion, when I talk about extreme opinion, I'm talking about a pervasive issues. We eliminate the critical audit matters. Okay. We eliminate critical audit matters. The good news is everything else remains the same. The last three items that are here. Okay. That's pretty good. Have I asked questions about the disclaimer of opinion report on previous exams? Yes, I have. Okay. I'm an evil human being. The sooner you guys realize that, the better off you'll be. You'll be less disappointed. I'm not entirely guaranteeing that I'll ask you about disclaimer of opinion on the next report, but you do need prepared for this. And it is a pretty big booger, but it's an important one to note. All right. If you get into a situation where you're just completely and totally baffled, remember what I told you. Anything that refers to opinion has to be changed to disclaimer opinion. Anything that refers to a job responsibility has to be changed or removed. That's basically the nature of the opinion in the disclaimer. Yeah. All right. That's it. That's audit reports, but we have a few more things we have to talk about. So this basically talks about the name terms for pervasive. What does pervasive mean? By definition, pervasive effects on the financial statements are those that are not confined to specific elements, or if they are confined to represent a substantial portion of the financial statements. Remember, we just looked at a disclaimer of opinion that actually dealt only with inventory. What is the line of business that Earthwear Clothiers is in? Sales of retail inventory, okay? Sales of retail inventory. If their inventory cannot be audited, is that a big problem for the auditor? Says, well, your entire line of business we couldn't actually audit, but everything else was okay. Yeah. So that was why we had such an extreme opinion for one account. With regard to disclosures, they're fundamental users' understanding of the financial statements. So it needs to completely change the perception of financial statements to be pervasive. All right. Now with that, we need to talk about a few more additional issues. By the way, we're, what are we in? 36 minutes into this lecture. This is the most important 36 minutes with respect to this lecture. Everything I'm going to talk about afterwards, maybe a multiple choice question, but this is the stuff previous to this that's going to be on that problem, okay? So if you're going to review and review this previous 36 minutes, first of all, don't do it on 200 times speed. I am unintelligible, okay? 75% speed is about right, okay? Secondly, make sure that you pay very close attention to the format of the reports. I gave you a lot of tips and you need to kind of pay attention to those. I will ask very probing questions about that. And I will expect you to have innate knowledge of the audit reports. No more so than I do, okay? If I can repeat it verbatim, then you should probably plan on being able to repeat it verbatim as well. It's like, well, Dr. Barnes, you've been teaching this for 10 years. So yeah, I know it's unfair. Life is unfair. All right. What else do we need to talk about? We need to talk about a few special reporting issues. So these are the types of reporting issues. Let's get into them. So first of all, reports on comparative financial statements. Remember we talked about in the audit report, it presents information for the current year and the previous year end audit, and then for other financial statements, 3 years running, all right? Comparative financial statements are pretty much the standard for any type of periodic reporting that occurs. This is especially true for publicly traded companies. For their 10Ks, they will present their financial statements in comparison to previous years. Has everybody seen that in the 10K before? You've had to do like a trend analysis and you say, well, let me go look at the financial statements. Okay, here's the income statement, 2025, 2024, 2023. Okay, that is pretty much standard for reporting. Now the question comes up, what happens if there's differences in opinions from the previous period and the current period? Well, if you look at the audit reports, the audit report says the financial statements for both periods had this opinion. What if my audit opinion for the current period was an unqualified opinion, but my audit opinion for the previous period was a qualified opinion? Do I get to say in the current period, well, they're unqualified for both years now? No, okay, that's a misrepresentation of the position of the client. If you have different opinions for different periods, you have to make that clear in the opinion paragraph, okay? That's an important point. That doesn't happen very often. I will say 99% of the reports you'll see under PCAOB reporting will be unqualified, but it can come up, okay? Particularly if there's issues with reporting such as scope limitations. These are going to usually be explained. So if we have changes in prior period reports, these are going to be explained expressed by explanatory paragraph. This basically means if prior periods were listed as one opinion, but they're changed to a different opinion, we have to verify that in the subsequent paragraph. So let's say in the previous period, I audited them originally and I issued a qualified opinion. They retroactively made restatements to their report. We re-audited and we made a change in opinion to unqualified. Their original statement, their original financial statement still have that lingering qualified opinion. So I need to say, we are now presenting both periods on an unqualified basis. The reason why is they went back to their financial statements to reflect the proper adjustments. So if there's a change that needs to be expressed, then we have to put a paragraph there. what does the predecessor auditor have to do? Okay, what does the predecessor auditor have to do? So they should do the following before reissuing a report on prior year financial statements. So this is basically saying we're a first year auditor. We're going to use the predecessor auditor's prior year reports in our comparative financial statements reports. Well, we're not the ones who did the previous year audit, so we need to make sure the people who did understand how we're going to use that. So they need to read the current period financial statements, compare current period and prior period financial statements, and then obtain a representation letter. All a representation letter is saying is that we, as a current period auditor, have asked permission to use the prior period auditor's work in our presentation, in our report. So it's just basically saying we're not misrepresenting anything. We're just telling what happened in the previous year, so we can present this on a comparative basis. All right. Now, what about other information and documents contained in audited financial statements? So beyond the financial information presented, the auditor has no responsibility for information contained in annual reports, registration statements, and the like. However, the auditor is required to read the other information and consider whether it's consistent with the audited financial statements. So this has important implications. So first of all, we are not auditing anything in an annual report or other type of non-financial statement item other than the financial information. So financial statement information is used. Naturally, we're going to audit that because we did audit it. We audited it for the current period. We do have a responsibility to read the information and make sure it's not misrepresenting a position. Now, has anybody ever read an annual report? And I'm not talking about a 10K, I'm talking about actual annual shareholders reports. This is an example of a McDonald's shareholders report. Look at that Big Mac. That looks delicious. Has anybody ever seen a Big Mac that actually looks let's say, has anybody ever seen a Big Mac that looks delicious? Full stop. All right. I used to work at McDonald's. Again, I get to make fun of the companies I used to work for. Okay. I mean, I was a big fan of Big Macs when I was like 12. Okay. But now I look at that and I say, there is no way this Big Mac would exist in reality. Annual reports tend to be sunshine and rainbows. They portray the company in the best possible terms. So they may try to misrepresent details of the organization, especially if those are details are important. Again, we don't have any responsibility for reporting in this context. We're only concerned about the financial statement information. But if they misrepresent anything related to the audited financial statement information, we as auditors have to step in and say, no, that is not a proper use of the information that we've audited. You cannot misrepresent this information. So if they said we had $1 million net income when in fact they had $1 million net loss, well, that last word is really important. Income and loss mean drastically different things. Okay, so we have to make sure that the information being represented is consistent. All right, let's talk about some special reports. So auditing standards provide specific guidance for reporting in several situations. Okay, financial statements based on basis of accounting other than generally accepted accounting principles. You will hear me talk about departure from GAAP in this course. I will frequently refer to what does GAAP say, financial statement accounting, because most of the time we're going to be dealing with accrual-based accounting. Okay, what you learned back in 220 and have consistently used throughout. That does not mean that accrual basis accounting is the only basis of accounting. In fact, I would argue that outside of a university, a lot of organizations don't even use accrual based accounting. I think QuickBooks is kind of default as cash basis accounting. So accrual basis accounting is one of those things that we may not be using, especially if we're talking about small clients. What about specified elements and accounts or items on their financial statements? If engaged to audit them, yes, we can, particularly for non-PCAOB clients. We engage in audit that's only going to be part of the client's operations. And then compliance and agreements with or aspects of contractual agreements and other regulatory requirements. We're going to talk about each of those here in just a second. So, all right, yeah. So special purpose frameworks. One type of special report is employed when an entity has prepared financial statements on the basis other than generally accepted accounting principles. Now, we're not going to talk too much about the auditing procedures here. First of all, the auditing procedures themselves don't change substantially. We can still apply generally accepted auditing standards if we're not using generally accepted accounting principles. I know that sounds counterintuitive. It's like, well, if you have one that's generally accepted, you have to have the other generally accepted, right? I'd say not necessarily, okay? GAS is about how we conduct audit. GAAP is about how our client reports their financial statements. They can use other bases. So auditing standards define special purpose frameworks as financial statements preserved under the following bases. And this is not a comprehensive list, but an example of some lists. So a regulatory basis, one that's prescribed by the industry that they operate under. Tax basis, which is one of those rare times that I talk about tax in this course, okay? So generally speaking, tax and cash bases are very closely related. It's basically recognizing revenue and expenses when the cash is received or changes hands. Then contractual basis, if you've got an engagement that comprises a big part of your operations and it's going to change your financial statement report because of the terms of the contract, then you can actually apply to the contractual basis. Now, again, these are not going to differ substantially in scope from generally accepted accounting principles, but they may have a few nuances that are really, really important. Has anybody ever tried to operate via cash basis, do any transactions via cash basis? And once you get to accrual basis accounting, it gets really confusing. It's like, oh, cash, and I recognize the expense now. I'm not built for this. Yeah, it's really, really weird. So, but it's important to note that those types of bases exist. Usually, the only time that we have that is going to be when we're doing audits for very small clients, and even then are going to be certain specific engagements. Like if we're trying to do something like a client's trying to obtain a bank loan and need to audit the financial statements, that might be the kind of situation where this comes up. Also, an auditor can be engaged to report only on specific parts of the financial statements. So let's say you're here in Kirksville operating a CPA firm and they say, all right, we want you to audit the liability section of our balance sheet. Are you going to say this? Well, Dr. Barnes said we had to audit the entire financial statements under VCOB guidelines. What is the likelihood that we have many organizations here in Kirksville that are operating under VCOB guidelines? Probably not a lot, okay? Probably not a lot. So you can do that under ASB guidelines. They've specifically requested to do so, especially if we're not doing it for an annual financial report. We're doing it for some sort of basis that's going to be a one-time reporting deal. Again, like if they're trying to obtain a bank loan and the bank is concerned about their liability structure. Rather than auditing specified elements, accounts, or items, an auditor may engage to apply only agreed upon procedures. Now, we're going to talk more about agreed upon procedures not next week, a week from next week. I guess it would be almost 2 weeks from now. We're going to talk about agreed upon procedures. For right now, all you really need to know is agreed upon procedures are assurance procedures that are substantially less in scope than an audit. All right. Can an auditor perform those tasks? Usually, yes. It's not considered to be an audit. It's considered to be an attestation engagement, which kind of changes the terms of the arrangement. And then finally, for compliance engagements, which would be contractual agreements, regulatory requirements, etc., auditor provides negative assurance regarding the client's compliance with rules and provisions. So there's 2 important points to make here. We're talking about compliance engagements, compliance agreements. Usually this represents compliance with laws and regulations within a particular field or industry. So if a client operates within the energy industry, we want to make sure that their reporting matches what's required for them, because there may be specialized reporting terms that they have to follow under those laws, existing laws and regulations. It probably goes without saying that if we're doing compliance audits, we have to understand what are the rules that we're trying to make sure we're in compliance with. But more importantly is this term negative assurance. What was the term that we used for auditing when we talked about assurance? What was that word? Reasonable assurance, okay? So we have our spectrum, okay? And we're going to go all the way from the end of the spectrum here in the next few weeks, okay? So we have absolute assurance, which we know is what? Impossible. Absolute assurance is impossible. Then we have step down, which is reasonable assurance. This is where our financial statements audits are. This is the highest level of assurance that any type of assurance engagement can provide is reasonable assurance. We're going to talk about other types of engagements that can provide that level of assurance here in a few weeks. But for right now, we're going to say audit is kind of our highest level of assurance standard. Then we're going to go to the middle, which is going to be called limited assurance or negative assurance. And then the very far end is no assurance whatsoever. So what is negative assurance or limited assurance? Negative assurance is basically, instead of saying the financial statements are free from material misstatement or the engagement is free of material misstatement, basically we're saying we don't believe any material modifications need to be necessary. Instead of saying everything's good, we're saying we didn't find anything bad. Now, that seems to be kind of a synonymous term. You just say, well, that's basically saying the same thing, Dr. Barnes. And I say, is it really? Imagine the intention that you walk into, which is a more powerful statement. It's like, everything's fine. Like, oh, that's good. It's good to hear. You walk in and it says, I didn't find anything wrong. I don't know, that seems so small and minimal, but which gives you more confidence? Which gives you more assurance if you hear me say one of those two terms? Probably the former of the two. Okay, everything's fine. All right. You may question me, but you do get more assurance than that than if I say you're suspicious. If I say I didn't see anything wrong, it's like, well, there's something wrong. There's got to be something wrong. That's why negative assurance tends to provide lower levels of assurance than reasonable assurance. We're going to talk more about negative assurance in specific context here in a little bit, but for right now, we need to note that for contractual agreements, that's the type of assurance we employ. Contractual audits, not contractual compliance audits, that's what we employ. And that's it. Have yourselves a wonderful break, and I'll see you in a few weeks.